Hello, and thank you for joining us today as we look at the latest on ESG and CLOs. I'm Chris McGarry, a partner in White & Case's capital markets practice. I'm delighted to be joined today by Fiona Hagdrup, Simon Matthews, and Dushi Pavan, who will be introducing themselves properly in a moment. We'll be covering three main topics today. First, we'll be looking at the evolution of ESG in CLOs and leveraged credit to date. Next, we'll be diving a little deeper into the opportunities and some of the challenges, perceived and otherwise, for ESG in CLOs and leveraged credit today, including opportunities under the EU's Sustainable Finance Disclosure Regulation. And then we'll be ending by having a look to the near future and how we might see things develop over the next 12 months or so. Lastly, before I hand over to the panelists for their intros, just to flag that if you would like to submit a question to us, you should be able to do that. Hopefully you can see the Q&A function at the bottom of the screen that you're looking at now, and hopefully we'll have time to get some of those questions at the end. And so without any further ado, if I can invite you, Fiona, to introduce yourself.
Hello, I'm Fiona Hagdrup. I'm a fund manager at M&G. I sit in the private credit division and I'm managing loan funds, segregated mandates, and an open-ended mutual fund, investing mostly in private companies, albeit large cap. As far as ESG is concerned, I have a particular interest in our sustainability strategies, and we have recently launched some Article 8 funds under SFDR. So looking forward to the discussion on the next level for the private corporate market.
Excellent. Thank you, Fiona. Simon, if you would like to introduce yourself next.
Yeah, good afternoon, everyone. Simon Matthews. I'm a portfolio manager at Neuberger Berman. My responsibilities include our European CLOs, European high yield and loan business, and I'm based in London. For those not familiar, we have 32 active CLOs globally, including now 2 here in Europe. We priced our first post-crisis deal in Europe on the 1st of February of this year. Seems a while ago now. And our second deal we priced in early August here in Europe. So good to be with you all today and looking forward to the discussion.
Thank you, Simon. Dushi?
Thanks all. Good afternoon. My name is Dushi Pavan. I run the European CLO business at BNP Paribas, responsible for arranging CLOs, but also providing senior finance for portfolio managers such as Fiona and Simon to be able to warehouse and ramp vehicles with a view to exit into the capital markets.
Great. Thank you, Dushi. So we start with our first topic today, which is to look at the evolution of ESG in CLOs over the last 3 or 4 years. To tee it up a little, I mean, I remember, sort of first starting to talk about the topic in 2018, and, there was perhaps a little bit of skepticism at that point. I had the great honor at that time to work as the lawyer in the G20 Sustainable Finance Study Group, looking at how CLO structuring technology could be deployed to create new types of CLO, for the energy transition. So obviously, different underlying assets. But then gradually in 2018, I think we first started to see some signs of ESG type provisions creeping into some CLOs. So if we can start with you first, Dushi, and your experience of ESG in CLOs, maybe you could tell us what you were seeing before the pandemic and kind of how that's changed since the pandemic.
Yeah, sure. Thanks, Chris. So, I mean, just to take a step back, as you mentioned, so ESG inclusion into the criteria for CLOs has become a very important matter and certainly very topical for the CLO market. And just to give you a sense of that evolution, from 2019 probably and onwards, we have had focus from the end investor primarily into what we call certain exclusions of, I would call more the environmental and to some degree the social aspect of ESG with regards to restrictions around weapons, chemicals, some level of tobacco, but again, more an exclusionary comment. Certainly all managers that we have worked with and certainly that are in this space have their own independent and individual ESG policies, committee and goals towards achieving the best practice here. But it certainly became a very prevalent focus in 2019, again, mostly with the the negative, so-called negative ESG exclusion. I mean, fast forward through the pandemic and certainly into 2021, it is now market standard for CLOs to be limited from investing in certain sectors across the E, the S, and the G. I mean, I'll leave to Simon and Fiona to talk through the specifics of the restrictions, but definitely negative ESG is market standard in CLOs to date. The next evolution has obviously become the focus on more positive, so-called positive selection or positive CLO selection, and that is still subjective to some degree, but with some elements of focus on making the selection more quantifiable or objective. That's pretty much where we are today in terms of CLO selectivity and ESG.
Before going to Simon and Fiona, I mean, I think obviously agree with all of that, Dushi, and what's been sort of quite startling really is, as you said, certainly as far as we're aware, all the transactions we've worked on and, talking to everyone in the market, it does indeed seem that the negative screen is at this point ubiquitous. But now, like as you're saying, what we're starting to see is, both managers and investors getting more granular in their approach. And we'll come back to the definitional piece as well. But Simon, coming to you next, obviously you mentioned, I think you said, Neuberger's managing 32 CLOs globally, and about 30 of those are in the US. And you've obviously been looking at Europe for a while. And then, as you mentioned, you priced your first post-crisis deal earlier this year. And we were fortunate to be a Ranger side working on that deal for you. As you were looking to kind of come back into the market, at what point was sort of ESG woven into that conversation? And can you tell us a little bit about, kind of your experience with connecting the dots between your plans for CLOs and then, what you were already doing on ESG?
Yeah, happy to do that. And look, as Dushi's pointed out, I mean, clearly we've seen a lot of change just in the last couple of years, and it's been exciting to be part of that change and part of that process. And I think about starting to market our first European CLO really at the end of last year, and the conversations that we've had with the investor base, and it's just been actually very, very interesting to see how that's evolved and the response we've had as we've explained what our process is and what we feel we've been able to bring. And I think the thing to say from our side is, from a Neuberger's perspective, we're somewhat fortunate, and because we've had a robust process in place for many years now on the ESG side, we don't outsource to centralized function. Our 25-strong analyst team works through a standardized process and determines the score for each owned issuer. And of course, we have oversight at the team level, but of course the wider firm level as well. And because of the nature of the firm, the fact we're in equities, we're in other parts of fixed income, that area of strength that we've had as a firm, in terms of then applying that into European CLOs, we haven't had to do a lot new in order to do that. I think the new things that we have brought in, Dushi talked about negative screening there, and of course there are nuances across the market and different approaches to that. And one thing we have sought to do is to be certainly on that point one of the more restrictive in the market currently in terms of what our documents allow from a screening perspective. So, for instance, we do not include gaming in our deals. I think the other measure that we brought in, and we're not the first manager to do it, but we have committed to a level of transparency looking forward for our European CLOs. In the most part, we're going to be doing that through our quarterly ESG reporting. That process has just got underway with the first payment date that we've had with our first European CLO. But I can tell you, as well as in Europe doing that, that's also going to be a feature going forwards for our US CLO platform at some point next year. We're going to move in that direction as well. So I suppose that's kind of a brief comment from my side in terms of our evolution and where we've come from and what we feel we can bring into this. And I'll pause there.
Great, thank you, Simon. And I'm glad you mentioned, your kind of groundbreaking ESG reporting that you're doing. I think you were the first to include something along those lines. One of the perennial issues over recent years has been the so-called, lack of definitions. What does it mean to be ESG? And I imagine Fiona will speak to this shortly as well. But of course, where we are today is much clearer on definition, and we'll come back to that. But even at the start of the year, end of last year, when you were doing your first deal, there are obviously market standards, ICMA, LMA, LSTA, and perhaps Fiona will comment on those in a moment. But beyond that as well, I mean, there were, on other limbs of ESG, we were starting to see, global conventions increasingly being accepted by regulators. And so, there have been for some time objective definitions that managers could use. So it was great to see, Neuberger committing to, kind of reporting by reference to some of the various objective standards. So Fiona, coming to you now, I mean, obviously you're coming at this with a, slightly different perspective to Simon, though, of course, overlapping, as a big investor in leverage credit, as you mentioned, you're part of your firm's sustainability leadership group as well. And, congratulations also on recently closing your senior secured loan fund, which I think you said is in Article 8 structure. Would you maybe want to kind of give us an overview of your experience of, ESG weaving into leverage credit, at the asset level, and then kind of maybe a few observations of your experience with the Article 8 fund structure?
Yeah. I mean, the first thing maybe to say is that there's definitely an evolution required from ESG integration and making the assessment of material ESG risks a conscious and methodical process and part of your investment process. It sounds a bit basic now, and I think it is a given for most managers, but that's the foundation really then for attempting to ratchet things up from a sustainability perspective. And most definitely the momentum has picked up. I mean, anyone can feel it, I'm sure, in the market, but it's probably important to have, first of all, sorted out the basics, if I can put it like that. And perhaps one thing that we share with Neuberger at M&G is that perspective. So I've certainly found that there are sort of phases of development, even at personal level. When first confronted with an investor that wants to grill you on ESG risk awareness, there's often the slightly defensive reaction. Well, of course, these risks would be inherent in any credit process. It's in our DNA, or some sort of similar response. And then what you fast learn is a confidence that comes from knowing the position of your asset class and your community of companies in a firmament. So yes, it's very easy to list the challenges that we have when lending, mostly to private companies that haven't always got their disclosure house in order, albeit that they may be doing an awful lot more than they are systematically and publicly reporting. But one is most definitely emboldened to ask for more and feel entitled to do that when bolstered by some backdrop and some context that comes from best practice of peers in the public markets and from observing what like-minded competitor firms are doing. I mean, in this space, none of us are competitors, of course. The collaborative engagement is, the most powerful of all. And I think increasingly, the more that we can bind together on common topics, just as is happening in climate with important groups like Climate Action 100. So within our own asset class, I think a lot comes from collective endeavor. So what we're trying to do now in deploying a specific sustainability strain to loan investing is exactly as you describe, really, to move beyond the defensive, the negative exclusions. I think they're important. They're if nothing else, it's an establishment of your getting it, of your bona fides, of your attempt to exclude patently unsustainable businesses over the long term. I mean, practices, operations. But really, what we should be celebrating is what positive action can be taken. And as I say, while it's easy to enumerate the challenges within the private corporate community, what we have is a fantastic opportunity for engagement with companies, superior, I'd say, even to many in the listed equity world. That right to have the phone picked up when you call, that we sort of take as our divine right when we're lending, harnessing that and deploying it in a focused way with a proper engagement, by which I mean, establishment of an objective and a timeline and goals, as PRI defined. These are really valuable attributes that exist, and in this asset class in particular. So, a marriage of awareness, what we do have, confidence to ask that comes from context setting. These have all been extremely important in hastening our own pace.
And I think building on some of that, Fiona, I mean, convergence is a theme you're touching on there, and the collaboration across the market. And I think in 2021, today we can say we're at the point where the substantial convergence has happened. And by that, I mean, we have the global policy level initiatives of climate, for example, in the form of the Paris Agreement. And then we know the market demands there, pick your, crazy stat, but $60 trillion by some estimates of investors out there looking for ESG assets. And then the third bit of the pike, so we have global policy, we have the market, but then, regulation has its role to play as well in helping, like, on the definitional piece and helping to kind of join all the dots. But if I can come back to Dushi, just to give us a little bit more color on, the investor perspective. And, you mentioned already, Dushi, that in terms of the negative screen, investors are expecting that. So, I think sort of kind of anecdotally, when people across the market are putting a pink offering circular out there, there's already something in there. But in terms of, things the investors are asking you about these days, Dushi, when you're, helping to arrange a CLO, can you tell us a bit more? Is it sort of every investor that it's agenda item 1 or near the top? And is there any kind of variance either across the cap stack or, across geographies in terms of the importance of ESG?
Well, certainly the importance of ESG is right up there for every investor. I don't think there's a single investor that hasn't flagged the importance of ESG to their decision making when it comes to investing in CLOs. I think managers look to try to address that because it is such an important topic by making it the second or third page of their manager book these days after the contents, to be perfectly frank. I think that is just putting it front and center to make sure that anybody looking at a CLO manager will know the importance of ESG to them as a CLO manager and also to them as a credit firm. There are differences between the level of diligence that an investor would like to get from a manager as we go down the capital structure and across investor types. But I think fundamentally people are really focused on the core elements of understanding any CLO managers or any other fund manager, to be honest, commitment to ESG. I think that's front and center, whether it's broader than just this transaction and across the firm. I think people will touch upon the mandatory or the market standard, as we call it, the exclusion list. So if there isn't a negative exclusion, well, I don't think there is, to be honest, nowadays, but certainly during 2019 and 20, there were some development of that. And I think you'd go even one step further, and again, to Simon's point, that there are different levels of exclusion. Certainly now there's a lot of focus on the granularity within all three of the compartments of ESG, whether what type of weapons, for example, what type of tobacco is being restricted, what type of palm oil production is being restricted, where are the revenues coming from each of those, the broader businesses, and are any attributable to the broader exclusion. That's definitely focused on. And I think the other one that's a key topic is the actual due diligence that the manager is doing when it comes or affording to ESG on the underlying asset class. And I think both Simon and Fiona touched on this as well. Is it just a headline number that, you're looking at kind of external information, or do you have a dedicated team to try to understand the real impact that any of these borrowers are trying to make to their various sectors, to their various industries? So I think those are kind of definitely the key themes that we're seeing across investors that's the core category. And as you drill down, most investors have a dedicated questionnaire of such covering all of those topics. They will ask the CLO manager. It's very difficult for every single CLO manager to adapt their information, the knowledge on ESG or their criteria ESG back to the investor. So typically what happens is it's the inverse. The manager will outline their individual ESG strategy, individual ESG policy, and disclose that and just disseminate that amongst the various investors. And of course, then it's follow-up in terms of the details at the various levels.
Just one last question on the investor perspective for now, Dushi, is obviously the SFDR came online on the 10th of March. Elements of it, are still to come online next year. But we've seen a quite startling adoption of, the Article 8 fund structure across Europe. And, I imagine Fiona will speak some more to this. But, according to Morningstar's research, in the first 4 months of the market, 3 trillion euros of funds in Europe had voluntarily badged as Article 8, including, and when you think it took the CLO market, 20 years to get to $1 trillion, and Article 8 did, it sounds like they did it in like a month. But, I think that's got to open up the potential to bring new investors into CLOs, if CLOs show that they're a way of communicating the bond market's demand for ESG to, private credit, to leverage borrowers who aren't accessing the market directly. But have you seen, Dushi, like new investors coming with a real ESG focus, and or, how many of the investors are, as part of their ESG questioning, looking for help with their own SFDR compliance?
Yeah, so on the former question, on the first question, yes, absolutely. There's definitely a broader investor base looking to expand their universe of products if they then satisfy the requirement for ESG. And that naturally creates more demand for the product and supports the product and so supports the pricing. As we go through to try to understand what does that mean in terms of for the individual CLO manager to be able to then report or the requirements, and we'll talk about that a little bit later, but there's definitely a development needed there to try to bring CLOs up to the kind of the Article 8 type requirement. But there is definitely a strong push, I would say, from the investor community to try to move in that direction.
Perfect. Okay. So I think now we'll come back to Fiona and Simon. Fiona, starting with you, if I may, if we can, talk a little bit more about, if you can tell us a little bit more about how M&G developed its own, proprietary approach to ESG, and, if there were any objective inputs into that, because it seems to me that, it's in a move welcomed across the market. I think we all understand that with climate, that we're on the clock. So we can't let perfection be the enemy of the good. And so there are, and have been for some time, these various global standards. And I think, when M&G was developing its own proprietary methodology, were there objective inputs in it? And how do you see that kind of evolving going forward? What's the place for proprietary near a medium term? Will it over time become a totally objective standard for everyone across the market?
They're quite profound questions. I agree with the principle that we shouldn't wait for perfection and we should get started. I think institutional clients demand it too. And you see the pace at which institutions are signing up to make holistic commitments about their AUM, net zero asset owners being an example. And they're not really differentiating between the stakeholders and the ways in which we might be exposed to various parts of the economy that can have real world impact. And the vast number and sheer size of companies that are now privately owned means that, collectively we also have to play our part, so that there's no time to wait. As far as objective inputs are concerned, I think probably like a lot of houses, the foundation for risk discernment or categorization with some method of comparability inherent in it was the SASB framework. I think that's the foundation for a lot of folk. Lauded on then comes in-house decades of investment expertise. And I think that tailor-making angle is particularly important in our private world, where you have so many sectors that are effectively kind of niches of sub-niches. We defy GICS, for example, just to pick on one very practical challenge. The method of sorting and slicing and dicing by sector that is so common to the public community isn't easily acceptable for the private. So, one's first challenge is trying to make sure that your sorting looks something like the sorting that might be going on the public side or in the wider firm. So having a common methodological approach to risk assessment is important. And then, as I mentioned earlier, the context setting. But I think there's no outsourcing this. Ignore for a second the fact that third-party coverage of our world is low. We are, those that are lending, that are actively in a relationship, are best placed to assess and to have influence. And if you're in a community that is evolving, you're holding them to a context that's established by best in class on the public side, but you're recognizing that they're a work in progress in many cases, then the crucial thing to be assessing is intent, as well as current status quo on sustainability matters and target setting, for example. And that's inherently, I suppose, a subjective opinion, albeit based on an objective and well thought through methodology, and albeit with some context from a public side that will be covered by in-house analysts and also by ESG scoring vendors, if I can put it like that, or data vendors. But you're still largely on your own in the private corporate community. So, the more of us that are acting and talking the same language, the better. Albeit inherent is, of course, an ability to judge something that is quite subjective, as I say, like intent. How long and when? These are crucial questions.
I mean, I agree with all of that, Fiona, and I think as you describe it, they're evolving. I think we're, this decade, given, the scale of these global issues we're facing on energy transition, equality transition, and just the size of the market. If there really are tens of trillions of dollars out there wanting to get to work, we know about the often sluggish pace of regulation and catching up. We won't ever be at a point where suddenly, everything's aligned. But as you say, and we'll come back to the theme of disclosure and measuring intent, when you're putting it out there as a sponsor, like this is what we're trying to do, these are the big drivers for us, well then, the market is going to tell you over time whether you're doing enough or not. So Simon, kind of same question to you, if you can tell us a little bit more about how you had any objective inputs coming into, the Neuberger proprietary approach.
Yeah, I mean, look, I think picking up on what Fiona was saying, I think the other angle to mention, for everyone's benefit is when we're talking about objective information here, we've got to keep in mind that for many of the issuers, European levered loan issuers, that obviously are going into CLOs. I mean, there's certainly an element of reporting generally needs to improve. Now, I don't want to in any way play down what I think has been some really fantastic improvement that there has been in the last couple of years from an ESG perspective. And I think that's the fruit of efforts from all sides. We've got cap markets that are now prepping issuers, our efforts on the investor side, outreach to management teams. You've got organizations like Alpha, the LMA, who are helping with standardization. And so there's definitely been a big improvement on that front. But we have to acknowledge just briefly here that when it comes to objective information, given the lack of third-party information, as Fiona mentioned, around this asset class, we are needing to get that information from issuers, and ultimately the quality of what we're able to provide from an ESG perspective is somewhat contingent on that. So I think it's worth making that point. I think the other feature I'd say, and this is crucial in terms of our internal approach, and I'm sure for many other managers as well, but it's just so important to have access to management, to be able to talk to them, to be able to obviously submit our questions, and whether it's through more standardized questionnaires or whether it's through other means, getting information and just thinking through the different areas of quantitative disclosure. I would say on ESG, it's particularly the area of our environment and the area of carbon intensity. Here we are, we're just approaching the summit, obviously in Glasgow the next few weeks. Is going to be a big area of focus, but that area of we need information from management teams as to what the level of carbon intensity is across their different activities, and it's that area in particular that I kind of see a focus going forwards and increasingly that we're looking at. So may not be exactly your question, Chris, but I just wanted to put that in as well as really important to this debate.
Yeah, no, that's perfect, Simon. It actually kind of segues nicely into just a quick overview on some of the key points under the SFDR for the market. And, first, probably to say for the old CLO hands dialed in today, I think all of us, we hear about a new piece of EU regulation. There's a bit of a sigh, we're thinking, here's some compliance burden. The SFDR is completely different to that. Because the main focus of the SFDR is about facilitating the market. There is obviously a compliance piece for EU banks and large EU buy-side firms, but the facilitation piece is kind of twofold. And first, they've given us now under the SFDR clear definition of what it means to be an environmental asset and what it means to be a social asset. And for environmental assets, you get cross-referred over to the Taxonomy Regulation. And there, several things qualify, but the two main ones, climate change mitigation and climate change adaptation, and the former, think energy transition. And then hopefully there are some bright lines. So unfortunately, clean coal, that doesn't count under the EU's taxonomy regulation. And then on the social side, well, it's only been fake news for about 73 years that there's no such thing as a clear international definition of what a social investment might be, because the world signed up to equality in the aftermath of World War II and the Universal Declaration of Human Rights, which is indeed one of the objective global standards incorporated under the SFDR today. And so, the UN fast forward, its latest initiative is obviously the 2030 Sustainable Development Goals. Within that, on the different equality and social measures, there are various indicators. And, one of the most obvious ones, when 50% of the planet isn't treated equally because of their gender, well, that's a pretty obvious thing that every company can do something about. Every company can do something about climate as well. So there's a definitional piece. And then the second major piece of facilitation is creating these two new types of fund structure. An Article 9 fund, which is perfection, because 100% of its assets are ESG. And then an Article 8 fund, which is, I think, the thing that's going to transform so many markets. And you add the definitional piece with then the flexibility of the Article 8 fund structure, that picking up on what Fiona and Simon are saying, it's a broad enough concept that the manager's able to say, well, what are the sustainable objectives of my Article 8 fund? And to dust down an old white and case joke that we've been using for several years in these webinars, there are more than 50 shades of green within an Article 8 fund. And, at the lighter green end of the spectrum, you've got to do enough so that it's, definitively ESG and investors can take some comfort. But to give a flavor, the negative screen so that investors know that they're not funding hydrocarbon production or controversial weapons, etc. That's kind of table stakes. But then beyond that, and Fiona, I'll come to you first and then to Simon. I mean, Fiona, you've recently closed an Article 8 fund that invests in leveraged loans. It's a fairly simple process in many ways in terms of the pre-contractual disclosure you need to provide. But on like the first page of the form that you fill in, you actually have an option, don't you? I think, where you can say, we don't have a specific minimum sustainable investments bucket. We may be targeting that, but if you say you don't have, minimum investment bucket, you then say what, you're excluding certain industries and focusing on other areas. Could you tell us a little bit about kind of your experience with that?
Yeah, I mean, first I would say don't do it if you're not feeling the confidence yet of purposeful, sustainable investment, including in the private sphere, because you have to feel authentically that you can discern a strong, sustainable company from another. That the strategy is really celebrating and optimizing those companies that are best in class. I'm going like this because, of course, the all challenging thing is defining the class. And there's no easy means, and nor should there be really, of subdividing this just into leveraged loans as an asset class, because, we're trying to assess the real world change that these companies can make. So, arguably the class is really the entire corporate community. So when getting beyond the listed exclusions themselves for sustainability reasons and a desire to demonstrate avoiding harm, I think you, as I say, you have to discern what good looks like, and that's probably based currently on in-house proprietary methodology that has been well thought through and employed, and I would say in other areas as well where data might be more forthcoming. Ideally, you'd be bolstered with an in-house sustainability and stewardship team who've got a long experience of being impactful in the public community, so that they can, bolster the long dyed-in-the-wool leverage loan analysts and make those interactions into impactful engagements. So I think only then are you going to trust to the momentum. I think you mentioned regulation. There's going to be inordinate help from regulation. It's all slightly moving at different paces and focusing on slightly different things, but there's some coordination, I suppose. I mean, most crucial for our world, I think, is going to be the hastening of that systematic disclosure that Simon mentioned, that is expansion of the non-financial reporting directive. You're already seeing it in sort of hodgepodge fashion in single countries, but this requirement this legal requirement to disclose certain core basic metrics, that's a train that's at the station, and it is going to help our world with more rigorous, consistent data disclosure. So I think, having a faith in that allows one to extrapolate. So the sustainability strategies of today, I think, can, as I say, recognize a good company with good intent and encourage more. Of tomorrow, and for the leverage finance world specifically, then I think we can dare to dream of having thematic goals to our investment objectives. I think currently that might curtail one's universe too much to be quite that specific on a particular theme. And when you think about the asset class that really is all about downside risk, while we all want to say we're stock pickers, of course, diversity is a key defense in any portfolio. So really important to know that you're going to have enough of a population of sustainable companies to pick from by the time that you've enumerated what you're not going to do and set your tolerance bar for good on what you are going to invest in.
Thank you, Fiona. And as always seems to happen when we talk about ESG, we're running out of time already. So if we can just gaze forward to the next 12 months or however long a time horizon you would like to look at, 12 months from now, Dushi, where do you see, what are some of the things you expect to see in CLO docs?
Yeah, so I'm going to pick up on what Fiona mentioned, obviously, in terms of just building your portfolio. So there's definitely a demand right now from the investor base to encourage more reporting on a best efforts basis by managers, certainly for Article 8. So that would mean that there is pent-up demand out there within the CLO natural universe for this. So the question becomes, will there be sufficient pool, if you will, of assets that then satisfy the relevant criteria as objectively measured to then fit within your standard CLO? So I don't know is the honest answer, but I think we're all moving in the right direction and everybody wants to move in that right direction. So in 12 months time, can I see an Article 8 CLO? Personally, I think yes. I think there's going to be many factors that will be required to contribute to that. And fundamentally, it's going to be about, is there enough of a universe of assets to do so?
And one quick point on that is, given the the overlap across CLOs, I guess two possibilities are: the market might move en masse, if the borrowers, to Simon's point, start providing data, especially on the environmental, that could attract a whole new investor base to the market. So there could be a pricing benefit across the market, and then still there would be scope for tiering, I suppose, for the more ambitious managers. Is that a scenario that, admittedly we've got a few steps to get through, but is that a kind of scenario that you view as possible?
Well, you're seeing it already now, right? In terms of, I think one of the questions or comments topic that we discussed earlier was kind of just the introduction of positive ESG and a broader investor base. We're seeing it already. I mean, certainly for Simon's deals and a few others where you had much more of an objective measure of ESG scoring. There was increased demand, or there is an increased demand of investors, which naturally lead to competition, leads to kind of better pricing, et cetera, et cetera. So you've got the natural demand dynamic there. And that I can't see that curtailing at this point in time, to be honest.
Thank you, Dushi. Simon, next 12 months.
Yeah, I'll just add in briefly on the Article 8 discussion and where it goes from here. I think a big step is what's happening with the SFDR reporting, and asset managers have got a lot of work to do around that in the terms of the June 22 deadline. I do think that may be a bit of a pause for thought upon managers as to why we're not necessarily moving quicker in this direction. Would be my view around that. I think the other thing, just projecting over the next 12 months or so, I do think we'll see more in the way of positive screening, maybe not over 12 months, but longer term. And part of the feeder into that, if you think about the loan and bond market and the growth we've seen in terms of number of new issuers, M&A, LBO issuance, and particularly this year, more issuers, more diversity available, it becomes easier for managers to start to make exclusions, to start to have positive screening approaches. It's going to take time, but clearly that's the direction of travel.
Thank you, Simon. And Fiona, if you'd like to bring us home with your thoughts for the next 12 months, might we see the 60-second CLO manager in Europe or whatever we're up to?
Yes, I'm sure I am. I mean, the one thing we haven't spoken about is the effect of the private equity sponsors. So when I say we're all in it together, of course, I mean them too, and the companies. And certainly there's a tiering, but for those that are propounding good sustainability practice, then things move fast in that portfolio. So as a prelude, some Article 8 PE funds might spawn debt offshoots, of course.
Brilliant. Well, we are 2 minutes over the allotted time. So apologies that we haven't had the opportunity to get to any questions, but if anyone dialing in would like to follow up bilaterally with any of us, I'm sure we'd all welcome that. Thank you once again to Fiona, Simon and Dushi for taking the time to share their experiences, thoughts and views on the future with us. And thank you all for joining us today. Hopefully see you again in about a year from now, and maybe we'll see how accurate some of the predictions have been. Thanks very much.